Welcome back to Alpha Recap. It's Adam. We're looking back at the market action from today, February 11th, right after the close. As always, if you have questions, you can reach us at stockalpha.ai. Matt, great to have you on to unpack a busy tape.
Thanks. Glad to be here. There was a lot packed into today's session, some clear winners and some clear warnings. It felt like a story of two markets.
Exactly. To set the scene quickly, markets closed mixed with clear gains in semiconductors and chip equipment names, while a number of consumer exposed names and payments names looked weaker. Let's start with the semiconductor strength. What kicked that off?
The main trigger was a report that Taiwan Semiconductor Manufacturing Company saw a pickup in foundry orders. Foundry demand is the heartbeat of the chip supply chain. When it ticks up, it raises utilization, supports pricing for equipment makers, and often signals a multi quarter capex cycle. So we saw that narrative lift chips and the equipment suppliers tied to them.
You use the word capex cycle. Break that down for listeners who don't live inside fabs. Why does a little uptick in foundry orders matter so much?
Good question. Fabs are massively expensive. We're talking about billion-dollar plants. They're also capacity constrained. So if demand goes up even modestly, that can drive higher utilization and push companies to phone in equipment orders. That, in turn, benefits tool makers and material suppliers for many quarters. It's not just a one-day bump. It can be a multi-year revenue tail for suppliers.
And we heard some positioning from active managers that echoed that. Sustainable Growth Advisors disclosed a meaningful bet on Broadcom in their fourth quarter of 2025 letter, right?
Yes, their U.S. large cap growth strategy showed modest absolute returns, about 0.3% gross and about 0.2% net for that period. But the bigger signal was conviction. Broadcom sits at the intersection of semiconductors and high margin infrastructure software. So a concentrated bet there tells you some managers are leaning into a dual secular and cyclical theme.
That hybrid model sounds attractive on paper, recurring software revenue with cyclical semiconductor upside. But the tape wasn't uniformly bullish today. There were clear signs of consumer strain. Walk us through that side of the tape.
Right. Two things were notable. First, Bank of America's internal indicators flagged some weakening in consumer spending patterns, wallet share metrics that often foreshadow broader retail trends. Second, the latest retail sales print came in soft. When you tie those together, it signals stress in the middle of the income distribution, which is a classic example of a K-shaped recovery where some pockets do fine while the middle struggles.
And that stress showed up in action by active managers. Matrix Asset Management sold a payments name after an earnings miss. Yes?
They sold Fiserv after an unexpected earnings miss. That's an archetypal active manager move. Cut exposure after a surprise miss. The thing to watch is that these moves can amplify weakness across a sector, especially if other funds follow suit or if it triggers index related selling in smaller caps.
So, on one hand, you've got a cyclical, constructive narrative in semiconductors, and on the other hand, you've got customer facing revenue stress that could crimp demand for some chip end markets. That creates a real debate, right?
Exactly. It boils down to growth versus macro caution. The semiconductor bulls argue demand is genuinely ramping, especially for data center and AI related hardware. The cautious camp asks whether that demand is broad based or concentrated in a few pockets, while consumer driven end markets, think smartphones or wearables, might be softer. If the end market demand isn't broad, the capex cycle can be more muted.
Let's switch to the event driven side of the tape. There was a flurry of 8K filings and some smaller cap names that saw big moves. Astera Labs was front and center. What did we see there?
Astera Labs had heightened volatility. They reported revenue of $44.3 million for the most recent quarter and a GAAP net loss of 11 cents a share. Those numbers leave a narrow runway for bullish expectations. On top of that, there were reports of a potential business with Amazon, which divided analysts. Bulls focused on the market opportunity, bears pointed to the small revenue base and execution risk. That combination makes for sharp intraday moves.
And the filings, Bitmine, Frontier, Taylor Morrison, Vishay Precision Group, Transocean, a lot landed today. For listeners who don't track 8Ks, explain why these matter.
An 8K is how a company quickly updates the market about important events, results, material agreements, exhibits to deals, even management changes. Items like results of operations or regulation FD disclosures can include revised figures or pro forma adjustments. For traders, parsing that content on day one is a source of edge. For investors, it can change a company's risk profile if the exhibits show debt covenant issues or deal terms that weren't previously disclosed.
So we've talked about the three clearest threads: semiconductor capex optimism, selective de-risking in payments and consumer names, and event-driven volatility from filings and rumors. But there were debates inside each thread. Give us the main points of disagreement you saw.
Sure. First, whether semiconductors are recovering due to real broad demand or just supply front loading and capacity shifts. Second, how to interpret small cap rumors like the Amazon Astera chatter. Is it transformative or headline noise? Third, active conviction versus benchmark tracking. Sustainable Growth Advisors' concentrated bet on Broadcom contrasts with their modest recent returns, raising that classic allocation question. Do you prefer managers willing to concentrate for upside or those who stick closer to the index?
That's a useful framing. Let's get practical for different investor types. If I'm a growth manager or someone running a concentrated book, what did today tell me?
For growth and concentrated managers, the semiconductor and infrastructure software thread is a validation point for focused exposure, but you need thesis checkpoints, bookings cadence, capex guidance from customers, and gross margin trends. Because if consumer weakness spreads into device markets, that could blunt upside.
How about value or income investors?
If you're looking at value or income, the consumer data softness makes high quality balance sheet names and steady dividend payers more attractive. But be cautious with industrials that rely heavily on consumer spending.
Event-driven traders. What should they have been watching after the close?
They should have zeroed in on the details in filings for Astera and the other 8Ks. Look for updated guidance, exhibits that change capital structure, or any definitive confirmation or denial of rumored deals. Liquidity and spreads matter. These are high volatility plays, and position sizing is critical.
And retail investors, the long-term holders?
Retail investors should take today as a reminder to diversify. Semiconductors have structural tailwinds, but they're volatile and sensitive to macro. If you're overweight, be comfortable with the swings. If you're underweight, watch fundamental indicators like capacity utilization and major customer orders before adding.
We shouldn't forget risk-averse investors. What are the conservative moves here?
For risk averse folks, preserve liquidity and consider hedges on concentrated tech exposure. Also, laddering into shorter duration fixed income can help if consumer uncertainty increases. Avoid getting caught up in headline chasing around the small cap rumors.
Let's end with tactical next steps. What are the practical things investors should watch after today?
First, watch forward indicators, not just prices. For semiconductors, monitor capacity utilization, new fab announcements, and equipment order pipelines. For consumer health, payrolls, real retail sales, and wallet share indices are key. Second, treat 8Ks and Regulation FD notices as potential catalysts and read exhibits closely. Third, pay attention to active manager letters. Big bets, like the Broadcom position, are informative. Finally, for traders, define event windows and liquidity thresholds and size positions to survive headline noise.
Great checklist. Before we sign off, give listeners three clear takeaways from today's tape.
Okay, one, the semiconductor demand narrative reemerged and drove gains in chips and equipment, but it needs to be validated by sustained order flow and capex. Two, consumer signals are flashing caution. Bank of America data and a weak retail sales print prompted selective de risking, especially in payments and consumer names. Three, event driven filings and manager moves created short term volatility. Parsing 8Ks and manager letters can give you an edge if you're prepared to act.
Perfect. That wraps up today's recap. Thanks, Matt. always helpful to get your perspective. And listeners, if you have questions about anything we covered today, head to stockalpha.ai where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai. Thanks for listening to Alpha Recap. We'll be back after the next close.